Hello, I'm Ben Wallace, Research Director and Portfolio Manager at Grimes & Company. Today I want to talk about an important question we're asking in our 2026 outlook. Can quality stocks stage a comeback? To answer that, we need to step back and look at some unusual patterns that have been driving the stock markets over the past few years. The first major trend, which we've discussed several times in our outlooks over the past few years, is market concentration. If we start with the first chart, it shows that the rolling 2-year relative returns of the traditional S&P 500, which is market cap weighted, versus the equal weight S&P 500, where each member has the same contribution. The takeaway here is straightforward. Market returns have been driven by a very small group of very large companies, as the gap stands at 20% as of the end of 2025. For nearly 3 years now, the market cap-weighted S&P 500 has significantly outperformed the equal weight version. That tells us performance has been concentrated in the largest companies rather than spread evenly across the market. Historically, this level and duration of concentration is rare and comparable only to the late 1990s. And while past returns are not indicative of future performance, it is notable that after that concentrated period that ended in 1999, for the following 20 years, equal weight generally did better or was comparable to the S&P 500. This doesn't mean that a crash is imminent, but the concentration trend won't persist forever. At the same time, another unusual development emerged in 2025. Quality stocks, defined as companies with strong balance sheets, solid cash flow, and high returns on capital, have significantly lagged the broader market. If we look at the chart showing the MSCI Sector Neutral Quality Index, quality underperformed the S&P 500 by a record amount in 2025. On a rolling 1-year basis, the gap reached levels we haven't seen before at 9% in October. On a 2025 calendar year basis, the 5% underperformance was the largest since the quality ETF was launched 10 years ago, as well as the preceding decade of the underlying index. Now, contrast that with what is happening at the speculative end of the market. Using the ARK Innovation Fund as a proxy for speculative stocks, many of which are not profitable, and the ARK Index currently has negative profits overall, experienced extremely strong relative performance during the same period. The next chart makes this very clear. At the exact time quality stocks were having their worst relative run in October 2025, on a rolling 12-month basis, speculative stocks were having their best strength since the COVID era, reaching 75% relative outperformance. That combination is a classic sign of investors chasing future potential rather than current business fundamentals. A key factor here is the role of the so-called Magnificent Seven. These stocks dominate market returns, but despite their size and popularity, they actually meet most traditional definitions of quality. They generate large amounts of cash, have strong balance sheets, and can fund growth internally, including major investments in artificial intelligence. So the concentration issue isn't really about poor business quality, it's about portfolio construction and the growing reliance on market returns on a very small, highly correlated group of stocks. However, market participants have instead taken the lesson that opportunity lies in stocks with exciting narratives, regardless of the underlying business. This fits with a broader pattern we often see late in market cycles, a shift from internally funded growth to externally funded growth. When companies rely on debt or outside capital to grow, returns can look exciting for a time, but the risks tend to show up eventually. In our opinion, we feel quality still matters. The risks of speculation become clear when we zoom out. If you look at the 5-year table comparing quality stocks, speculative stocks, and the S&P 500 from 2021 through 2025, we see that, shown in red, the ARK's 9% 5-year annualized return is barely half the S&P 500's 16%, while risk, as measured by standard deviation, is more than double, at 44% versus 16%. On the other hand, quality stocks, despite its recent challenges, is just off the pace of the S&P 500 with comparable risk. So what does all this mean as we look into 2026? First, one key question is what should signal a quality comeback? Historically, quality tends to regain leadership when investors refocus on fundamentals, cash flow, balance sheet strength, and sustainable profitability, rather than just narratives or projected growth. It is hard to predict when the market will change its opinion. Fortunately, it is easier to identify quality factors today. Second, changes in interest rates and capital market conditions matter. When capital becomes more expensive and less available, companies that rely on external funding tend to struggle, while high-quality businesses that fund growth internally become more valuable. Again, it's hard to predict when this shift can happen, but it is possible to identify the characteristics of companies that might benefit in such a situation. Third, for investors who feel they may have missed parts of the AI boom, the answer isn't necessarily taking on more speculative risk. There are ways to participate through established, cash-generative businesses and through diversification rather than chasing the most aggressive stories. In fact, most investors with stock market investments today already have large exposure to AI trends. To wrap up, as we head into 2026, it still makes sense to own market leaders, including the Magnificent Seven. But it's equally important to manage concentration risk and maintain exposure to high-quality businesses beyond those names. While quality stocks have lagged recently, history suggests that durable cash flow, strong balance sheets, and disciplined capital allocation remain powerful drivers of long-term returns. And that's why we believe quality still deserves a central role in portfolios, despite what has been a challenging 2025. Thank you for watching, and please feel free to contact your advisor or another member of our team if you'd like to discuss this topic or your investments in general. For more quarterly outlook themes and insights, visit grimesco.com. Thank you.